Okay, welcome to Accounting 7101. Is anyone in the wrong class? Okay, all right, good. Now, first of all, my name's Mark Russell. Now, here we are. I'm here. This is me, number 2 there. So I'm the lecturer for Mondays for today, and that's my room, or my office number, my email, and consultation hour, which is after the lecture. So, but you can feel free to ask me any questions at the end of the lecture, particularly if we finish early, or during the lectures, or during the breaks as well. So you're welcome to ask me questions anytime you like. First of all, has anyone got any questions before we get going? Okay, so well done for selecting Accounting 7101. It's a very good subject, and we'll give you a very good introduction to accounting. Now, before I get going, a couple of things. I don't have many rules about how I run the lectures. You can come in any time you like, come in as late as you like. You can leave any time you like as well. Probably the only thing I prefer is if you don't talk at the same time that I'm talking. That's about the only rule I have. And you're of course welcome to, for consultation hours, you can also visit any of the lecturers as well, and the tutors. So let's have a look. And they're the tutors. You'll meet your tutorials start next week, so you'll meet your tutor next week. So the course aims and objectives, there are quite a few of them. We give you a very solid introduction to accounting. A lot of what we'll study this semester will be financial accounting, and as part of the introduction, and we'll take you from learning from basic transactions to being able to record accounting transactions, and then also all the way up to producing financial statements. And then also giving you some skills to be able to understand financial statements and to analyse them. So that's the textbook there, and I think you can probably buy it online as well. Sometimes questions I get is, do we need to buy the textbook? Generally, we recommend it, of course. All the tutorial problems are from the textbook, so it can be a bit difficult to do the tutorials if you don't have the textbook. And generally, we don't have answers to older editions of the textbooks either. The course profile, that's on Blackboard, and the course profile here's a copy here. Course profile. The course profile, it's a copy there. So that's got a lot of information to assist you, and it'll describe in particular, starting, I think we're about from page 4. It'll give you the rundown for under learning activities. So each week you'll be able to see what topics we're going to cover, and it'll also describe the tutorials there. So that's probably the most useful section. The other section that's of interest to lots of people is the assessment. So there's assessment information in 5.4, and there's some more information in section 5.5, some information about the assessment, which we'll describe here anyway in a few moments. So they're the course topics which are outlined in the course profile. While I remember this, also put up your hand if you've got any questions at any time. Also put your hand up if you can't understand me, if I'm talking too softly or too slowly or too quickly. So let me know and I'll try and adjust. I realise I have a fairly strong Australian accent, but there's not a lot I can do about it, unfortunately. So they're the course topics, and There's 3 pieces of assessment. So we have 2 exams. So there's a mid-semester exam. That'll be held on a Saturday at a date to be announced. The university schedules the exam dates, so we have to wait for the university to produce the timetable for that. There's an assignment which is due in looks like the second half of the course, so that'll be on financial report analysis, and then there'll be an exam during the end of semester exam period, which is usually at the very end of October, early November. Any questions about our assessment? Okay. And the lecture and tutorial materials, they're all on Blackboard, so hopefully some of you have logged on to Blackboard and navigated your way around. And so the lecture material should be available at least a few days before the lecture. And there's tutorial problems and tutorial solutions. And the questions will be released before the tutorial course, and the solutions will be available after the tutorials. The expectations. One important thing is a lot of students don't go to. They might come to the first lecture, so welcome to the first lecture, and then a lot of students don't come after the first lecture. They might study from home or just listen to the recordings. You're encouraged, of course, to come to all the lectures, because sometimes the recordings, not very often, but sometimes there's a technical problem and the recording might not be very good. So if you don't go to the lecture and the recording's not very good quality, then it can cause you some problems. So the idea is that the recordings of the lectures are not meant to replace attending the lectures. And there's tutorials there. So tips for success. The good news is we don't assume any knowledge, so we'll start you right from the basics. And I think generally with tutorials, you're given some time to attempt the questions, and then the tutor will run through the answers. But if you have a look at the questions beforehand, it'll probably help you, it'll be an advantage. It'll be up to the tutor, of course, so I'm not sure exactly how our tutors are going to run their tutorials, but they're all experienced tutors, and I'm sure it'll be good. And the other thing there is, of course, check your email regularly, because I think you'll get emails about exam times and exam information and other information. Okay, and this is the email etiquette. Just help us to identify you. Use the UQ student email, not Gmail or another email. And also give us your student number and your full name, and that'll help us identify you. Generally, most people with a query will email the course coordinator, so that will help our course coordinator, Acct. Okay, so anyone got any questions so far? All right, so let's have a look at our introduction to financial accounting. So what we're going to do is this week will be a very broad picture, so we're going to give you a broad introduction to accounting and describe some of the frameworks and how we look at accounting. And then, so we've just quite a bit of material to cover. And then next week we'll start to show you how we actually account. And so we'll look at the mechanics, the fine detail of accounting. But this week is more of a big picture view of accounting, and then hopefully answer some of your questions, why you're here and why you're studying accounting. So let's look at the learning objectives. So we're going to of course, introduce accounting, define it. We're going to look at the business context, different types of accounting entities or business organisations. Also, we're going to look at who uses financial reports or accounting information. We're going to look at some of the characteristics of accounting information and the qualities. And we're going to give you a broad introduction to the the environment in which we account. So, the introduction to accounting. So, I suppose the primary purpose of accounting is to produce information for decision making. So that's where the key objective or purpose of accounting is. We're going to produce information for decision making, and so that involves a process of identifying, measuring, and recording and communicating events or transactions. So what we'll have a look at. An example later on is we'll look at identify some transactions and then convert those into accounting information. And so that process involves recognising various events and then measuring them and then recording and communicating them, which is part of accounting. So, and the transactions we look at generally, particularly in this semester, we'll look at fairly common or regular transactions such as sale to a customer and also a purchase of, say, supplies. So here's a little bit more detail about the accounting process. So there's 4 steps there. So we identify the transactions or events that we're going to record in that first column there. Then we measure it, so using some accounting rules we'll measure. Then we'll actually, after measurement, we'll record the transaction or the event, and then we'll communicate it. So then we'll communicate it in different ways, usually by producing financial reports. And generally the first 3 steps are what we call as bookkeeping. So, and we'll look next week, we'll introduce you to double entry accounting, which is the basis of accounting and bookkeeping. Any questions so far? Okay, so big question is who uses accounting information? So there's a number of users. So we actually have two groups of users. Let's see if this works. So we've got on the left in blue are internal users, and then on the right and underneath in the white ovals, circles, are external users. So the internal users, of course, are people within the business. So this is within the accounting entity or within the business. So there's the management and the employees and accountants that are employed by the business. And then there's a range of external users, and there's a number there. The most important one would be investors. So, and also there are lenders as well. So if we've borrowed money, then often the lenders are interested in our accounts. And there's also suppliers of goods and services to our business. So they might be supply on credit. So they're also interested. And then there's the ATO, is the Australian Tax Office. So the tax authorities are also interested in our financial accounts, of course, and they're probably going to could use those to check if we're paying the right amount of tax. And Acct is the Australian Securities Investment Commission down the bottom there, and so that's the regulator of companies. So in the case of having a company which is an accounting entity. And also sometimes customers are interested as well. Yes? ATO is the Australian Tax Office, or Australian Taxation Office. So in Australia, that's it's the main tax authority. ASIC, the Australian Securities Investment Commission, the regulator of companies. Okay, any other questions? Okay, let's... So, as I briefly mentioned before, our parties that are involved with accounting are internal or external. So management accounting is the perspective from inside the company. So we have generally the management and the accounting people. So it could be the owners as well, if the owners are also employed by the company. And then financial accounting is the perspective of being outside the company looking in. So they rely on financial reports, which will be involved this semester with producing a set of financial reports. And they're, of course, published and released to everybody. And the external users, such as investors and shareholders, are interested in the accounting information in those financial reports. So it's just a brief introduction to different types of accounting. So this is, so if you were to graduate as an accountant with an accounting degree here and then go on and work as an accountant, you can work as what we call here a commercial accountant. So you could work for a business as an accountant inside the business. So lots of particularly larger companies employ accountants. And then there's also public accountants. So public accountants tend to work for accounting firms, accounting businesses, and they'll do a number of services and functions such as auditing and taxation services and consulting services as well. There's more different roles of accountants. So some accountants work for the government agencies or organisations, and also you can work for not-for-profit businesses. So they'll be charities, probably even the University of Queensland. It's probably classed as a not-for-profit business. So the university here would employ accountants as well. So there's lots of there's quite a few different prospects or potential for you to work in accounting in different ways. Oh, sorry, I've skipped ahead here. So, any questions about our working as an accountant? So let's have a look at learning objectives today. So that's it. So we're going to define accounting. Actually, we did look at this before, so I don't really need to run through this. The other thing we're going to do today is that we're going to introduce you to the four main financial statements as well. So let's have a look at different types of business organisations. So we've got four there. The first one relates to proprietorship. So that'll be individuals that start a business. So if you were to go out and start your own business, then you might be called a trader or sole trader or proprietor. And then, so that's a relatively simple form of business. You could go out and start a small business and run it yourself. And so you have everything in your own name. And the other type of business is a partnership. So if you combine with other people and then you have an agreement between yourself or amongst yourselves on the business, then you can form a partnership. And then again, the business tends to be run as the individuals in a partnership. The third type there is a company. So the company is where you incorporate a company and you form a company, and so the company becomes the accounting entity, it becomes the business, and it also is a separate legal entity as well. And so then you're using the company name when you're involved with transactions rather than the individuals. And there's some other types of organisations which are trusts or not-for-profit as well. So let's have a look at in a bit more detail. So the proprietorship, so it tends to be a single owner, and the business is not separate from the owner. So there's no legal difference between the individuals and the business. So the business is conducted in the owner's name. And we'll look at later on toward the end of today, we'll look at the accounting entity principle, and so that says that what we'll need to do is when we do accounting for proprietorship, we'll need to separate the transactions of the business from the individual's personal transactions, and those proprietorships are usually small in size. So what was I going to... So if I can do a simple diagram. So if you have, so here's our proprietor, and then this is what I might call an accounting entity. So what we do is we separate the transactions, are all recorded in here, and all the transactions relating to the business are accounted for separately from the individual's transactions. The second type was the partnership. So this is where we have two or more individuals or owners, and then the partners are also personally liable, say, for the debts of the business. And often those enterprises or businesses are a little bit larger because there's more people involved, and it's a common form of business structure for accountants, lawyers, and even doctors as well. Third one there is the company. So the company is that there's a separate company or legal entity, and it's formed by shareholders. So it's probably most countries around the world have the idea that the companies are issue shares, and it's the shareholders, the owners, and have ultimate control. And the benefit of having a company is that there's separate legal, it's a separate legal entity, and there's separate legal liability. So if you're running a business and it's in the company name, then it's the company is responsible for the debts and the liabilities, so that individually you can protect yourself and protect your own funds and assets by running a business as part of a company. There are two types of companies. There's a public company and a private company. So most companies are private companies in that there's a limited number of shareholders, and it's the founders of the company decide to have a private issue of shares to family and friends and people they know. So in contrast, a publicly owned company is where the company is listed on a stock exchange, and the company shares are traded on a stock exchange. So in Australia, we have the Australian Securities Exchange, and in the United States, for example, you'd have the NASDAQ or the New York Stock Exchange, and so they're formed by what we call public companies. Okay, any questions about our public company, our business organisations? All right, so this is just a brief overview of different business organisations. And one of the advantages of partnership is that there might be broader skills and resources, having a number of people involved rather than a single individual. And the company also, it sometimes makes it easier to raise funds, raise money by issuing shares or borrowing money. The other forms of legal entity are trust. So don't really need to go into detail in a trust for our purposes for the subject, but a trust is an arrangement where somebody holds property on behalf or for the benefit of somebody else. So there's a separation between the legal owner of the property and the beneficiary of the property. Associations. Sometimes associations are a mixture. They're formed and they can be just individuals. Also, they can be incorporated as well, and sometimes under law, different legislation as well. So it'll depend on the individual association, what type of business structure they use. And there's also a range of government or public sector organisations. So they're often incorporated by an Act of Parliament or by the law. And so it'll depend on the individual case there as well. Okay, any questions on our business structures? All right, so that was number 3, the characteristics of main forms of business organisations. So what we've looked at so far, we've looked at the process of accounting, and we've looked at the users of accounting information, the internal and external users, and we've looked at different types of business organisations. Now we'll have a look at what's called the conceptual framework. So the conceptual framework is a document which describes the foundational, the basic principles of accounting, and it tends to support the accounting standards, which we'll look at progressively during the course. So the conceptual framework are the basic principles, and it gives us some guidance on how to account. So let's look at a bit more detail. So what the conceptual framework does, it provides answers to what's the purpose of financial statements, who are they prepared for, so who are the users of accounting information, and what assumptions do we make in our accounting as well, and what type of information is included, and what are the elements, what are the different parts of our financial statements. So let's have a look at some of the answers to those questions now. So the conceptual framework has an objective. So it's to provide information, financial information about the entity that's useful to investors, lenders and other creditors in making decisions about providing resources to the entity. So one of the key things here is we've identified that there's a number of different people or parties that provide resources to the business. So they might provide resources as an investor or shareholder will provide money when they subscribe to shares. It might be a bank or financial institution will provide money again as a lender. And it could be other creditors of the business, could be suppliers of goods and services. So if I'm running a business, and it's quite common, of course, if I'm running a business that I need to buy goods and services, and it could be just as simple as having an internet provider, a telephone company. I might employ people as well, and so on. So those creditors or suppliers of goods and services are also helped out by or getting information from financial reporting. So that's a fairly narrow class there, those three people. Any questions on that? On who our users are? What's the purpose? It's to provide information for decision making. So if I'm making a decision, do I buy the shares, or making a decision, do I lend money, then one of the objectives of financial reports is to help me make that decision. So the general purpose financial reporting. So one of the key things here is that it's called general purpose financial reporting. So just the first word, general, and the reason it's called general purpose financial reporting is that it's produced for external parties, people outside the business, who are not entitled to demand information, so that they don't have the power to go to the company and say, I want this information. So I have, with the financial reports are produced yearly, sometimes half a yearly, and sometimes 4 times a year, for the purpose of assisting outside parties to make decisions. And so they're produced for everybody. And so the financial reports, they're not tailored for any individual person or organisation. They're produced for everybody, and that'll include shareholders, lenders, and also suppliers or creditors. And of course the information is aggregated together. So generally, if it's an annual report, the information is a combination of all the financial activities of the business over an annual period. Okay, so let's have a look at, so that was the conceptual framework. So let's have a look at the bit more detail of the users of financial reports. So we've got three main uses of financial reports. So the first one there are shareholders or investors, or referred to here as equity investors. So they're the investors, of course, so this is the case of a company, is that there are shareholders. Generally, if we go back to the different forms of organisation, if we have a sole owner or proprietor, the sole owner or proprietor generally involved in the business anyway, so they have access to all the information. So they're if you like, an internal party, or involves management accounting. So the owner of the business, if it's a very small business, they'll be involved with the day-to-day activities of the business, and so they'll actually know, they'll have the information available to them, because they might be running the business as a manager of a small shop, for example, and they might actually be sitting behind the cash register taking all the money, and so they'll actually have access to all the information. So in the case of financial reporting, is that we're perspective from the outsiders. So the owners of the business, in the case of a company, can be thousands or tens of thousands of shareholders or investors, and there might be people like yourself. So you might go get on the securities exchange, stock exchange, and buy shares in a company. And so as a shareholder, you don't have the right to go to the company and ask for information, so you'll have to rely on the financial reports. And so this is the first class of users of financial reports, the shareholders or investors. The second class, as I mentioned, are lenders. So they're often the banks or financial institutions that lend money. And so they'll be interested in the financial reports, because they'll be interested in the company's ability to repay the debt, repay the loan, and also pay interest, which might accrue on the loan as well. Sometimes lenders, so if after you finish studying here and you go and work for a bank, and then a customer comes to you and says, I want to borrow $1 million, then sometimes what you can do is that you can, a condition of the loan is that you can say, we want additional accounting information. So sometimes in those cases you can get more information. So that's it goes beyond the general purpose financial reporting, and you can actually get tailored or specific information for yourselves. So at the moment here, we're just talking about financial reporting users, and so the lenders here in this example are people that have to rely on the financial reports of the company who are produced to everybody. Thirdly, the other creditors, so they're often suppliers. They're also, of course, employees. So sometimes the employees are interested in how the business is running. So if you, when you leave the University of Queensland, if you go and work for particularly a large company, you'll be an employee, but you won't have access to lots of financial information. And so sometimes you'll have to rely on the financial reports to understand how the business has been performing financially, and to get an understanding of the financial position of the business as well. So employees are interested in the financial health of the business, and sometimes there are customers as well. So customers might be interested, particularly if the company says that we're environmentally friendly and where our business doesn't doesn't damage the environment. So the company will produce information saying that we're ethical and we're environmentally friendly, and we source our supplies not from child labour or slave labour, but we have particular ethical conduct. So sometimes the customers are interested in this information, which is produced in financial reports as well. Any questions on the users of our financial reporting? Let's have a look. So that's a description there, what I've just run through. So the primary users, we've just talked about the investors or equity investors, lenders and creditors, and suppliers, and also sometimes some regulators might be interested here. So parties performing a review or oversight function. So that might be, we mentioned the ATO, the Australian Tax Office before, and also other regulators, the ASIC, the Australian Securities Investment Commission, regulator. Sometimes the Australian Securities Exchange, the ASX, also is a regulator of companies listed on the exchange. So, and sometimes governments and other special interest groups are interested in the financial reports. This is, I mentioned this here about internal users. So this is, as I said, the management. This is, they don't see, GPFR is general purpose financial report. So the internal users don't need to rely on the published financial reports because they can get the information themselves. So that, in the case example I talked about before, was the small business owner who works and manages the business. They don't need these financial reports because they have the access to the information as someone who's employed by the business or even managing the business or running the business. And also other people who are internal users are, say, company directors as well. So the directors of the business, of course, can command more information as well, which of course you'd hope for as well, because they're making decisions about the business. Okay, any questions about our users of financial information? All right, so let's look at the reporting entity. So the question is, the reporting entity is the accounting entity. So it's a business, or sometimes we refer to that as an accounting entity. And so who has to produce the information? So that's a good question. We've talked about different types of organisations, the structures, and we've talked about the users of the information and the accounting process. But the other key question we haven't looked at before is who actually has to produce accounting information and who has to report the information in financial reports. And so there's a very broad definition there, and it's a business or an entity where it's reasonable to expect the existence of users, which we've just looked at, the users who depend on these financial reports or general purpose financial reports to make economic decisions. And so if a business meets that definition, where it's reasonable to expect outside parties that need to rely on financial information to make decisions, particularly decisions on providing resources, then that business would be classified as a reporting entity and be required to produce general purpose financial reports. That's a very broad definition, and I know at this stage it's probably a little bit difficult to imagine which type of businesses. So a common one would be a company, would be a publicly listed company, of course, because if I'm a company on a stock exchange, I'd have dozens, hundreds or thousands of shareholders, and so that would satisfy the need to produce financial reports. But let's have a look at some other indicators here on what is a reporting entity. So the indicators or the factors which might help us decide on whether a business or an accounting entity needs to produce financial reports are listed there. So the first one is that the entity is managed by individuals who are not owners of the business. So this becomes quite common where if I start a business and then the business grows, and then after a while the business becomes such a size that as the owner I can't actually humanly or physically manage the whole business, because the business might be spread out over a number of countries, or might be geographically diverse, or it might be quite specialised. It might have technology functions that I'm not a technology person, so I can't do everything. So I might have to employ managers. And so once a business gets to a certain size, it needs to employ managers who are not the owners of the business. And so, which is always the case with a company. So generally the public company at least is that there's a distinct difference between the owners of the company and the managers. And so that's one indicator that whether financial reports need to be produced by that business. Second one is if the company or business or entity is particularly economically important or politically important. So there might be particular types of government organisations that would have to report. Or economically important would be just particularly larger assets, large resources. Politically important, there could be a number of different organisations that would have to report. You could make a case that this university here produces financial reports, so the University of Queensland produces financial reports, and it has, it might have, I don't know the current numbers, it might have up to 20,000 students, and it has something like, I think about 8,000 or 10,000 employees, so it becomes important enough to produce financial reports that people can rely on. And the third description there is just commercially or financially the business becomes a certain size, so it has it's considered it's to be large enough in terms of its sales revenues or its number of customers or a number of employees, and it also then is required to produce financial reports. So there's a list there of different criteria or indicators on whether a business needs to produce a financial report. A contrast to that, I might, if you walk around here on campus, around say the Union building and some of the businesses there, so some of them are relatively small. So if you've been to the lolly shop or, I'm trying to think of another example, the lolly shop might be a good one, or the bookshop or the stationery shop, then those businesses are fairly small, and so the argument would be that they don't need to produce financial reports. Well, one, because they're small, and the other is that they might not have a separation between the owners and the managers of the business as well. Clear example, there's some people that sell fruit and drinks near the Commonwealth Bank there. So if you ever walk past there and you know someone selling, they sell fruit and drinks and a couple of other things, that's a fairly small business, and so that would be an example of a business that didn't need to report on its financial affairs. Okay, any questions about our reporting entity? So what we've just looked at are our users of financial reports and who has to produce, what's a reporting entity. So let's have a look at what financial reports are we talking about. So what we have is, there are four main financial reports we'll look at in the course. So there's the statement of financial position, the first one. So that used to be called the balance sheet. Sometimes in textbooks, older textbooks and other materials, will see balance sheet. So the balance sheet is the statement of financial position. That's the first financial report there. Second one is the statement of profit or loss. So that's also used to be called the income statement. So sometimes I'll refer to it for simplicity as the income statement. So the statement of profit or loss. And so that's the second main financial report. The third one is a statement of changes in equity. So that gives you more detailed information about changes in the equity accounts. So I think what we'll look at first is the balance sheet or statement of financial position, and we'll see in a moment later on how it's divided into assets, liabilities and equity. And so this statement of changes in equity just expands out that equity section of the balance sheet, provides us with more detailed information. And the fourth financial statement is the statement of cash flows. So that'll be a statement which produces financial information about the three different cash flows, and we'll look at that briefly later on today, and we'll look at it in more detail probably in a couple of months' time when we look at the statement of cash flows in more detail. So that's the fourth main financial report. Okay. So any questions about those four? We'll look at each of those in a lot more detail during the course. So this is just an initial introduction. So our financial reports have what we call elements. But first, where do we see them? So the companies issue general purpose financial reports. So in Australia, they're issued, so Australian public companies issue them annually and also half yearly. So you'll see them. So generally, for most companies, their financial period is 1st of July to the 30th of June. So they'll issue the annual report generally within 3 months at the end of the financial period, which is the 30th of June. So we'll see anywhere between August and October, we tend to see the annual reports. So for the next 2 or 3 months, you might see in the media, you'll see news about companies issuing annual reports. That'll be the annual report for most companies. And then there's also half-yearly reports. So during the financial year, they'll produce a half-yearly report, which will be from the 1st of July to the 31st of December, and that'll be issued generally between January and March. In some other places, particularly the United States, they have quarterly reports as well. So some companies in Australia have quarterly reports. They tend to be resource or mining companies that have to produce information a bit quarterly. We won't really deal with that in this course, so you don't need to worry too much about that. American companies also have quarterly reports, so they produce information annually and quarterly. So the elements of financial statements. So what we do with the financial statements, we actually classify the information into classes. So the first class is for the balance sheet or statement of financial position, and there'll be assets, liabilities and equity. So that's highlighted here. So there are 3 important elements: assets, liabilities, equity. We'll look at that toward the end of today. I'll give you a very brief introduction to that. We'll look at this in a lot more detail next week as well. So they're the 3 elements of a balance sheet or statement of financial position. And for an income statement or statement of profit or loss, there are income and expenses. So we'll basically classify pretty much all of accounting information for our purposes as one of those 5 elements. It'll be asset, liability, equity, income or an expense. And then we'll do the accounting for that after that classification. That's a process that'll get we'll get lots of practice to that in the next few weeks as we go through the lectures and also in tutorials. So you'll get some practice at identifying what's an asset, what's a liability, equity and income and an expense element. Any questions on that? Yeah. So the first part of your question I missed is... good question. So the question was, can the company choose the different year ending? And they do. So a number of companies, this is publicly listed companies, do report, say, during the calendar year, 1st of January to 31st of December. Some of them have a report to the end of September as well. So it'll depend on the company, and sometimes the industry might influence their reporting date. The majority of companies, when I also do research into financial reporting as well. So if the Australian companies that I've researched over the last 8 or so years, most companies do the 1st of July to the 30th of June, but there are a large number of companies that have other reporting dates. Any other questions? Okay, so this is a little bit the goal or purpose or a brief description of our different financial statements. So the statement of profit or loss there, or income statement, so what that reports is, it reports the performance of the company, a financial performance over a period of time. So what it does, it calculates the income, which is including the revenues, and then it also calculates the expenses, and it deducts the expenses from the revenues and income to produce basically a profit or loss for the period. Second one is the statement of changes in equity. So that reports changes in the equity accounts. There's a term here called comprehensive income. That is not dealt with in any detail in the course, so don't worry too much if you come across the term comprehensive income, because what that does is that combines the what we call the basic income statement plus other comprehensive income. That reflects a change in reporting performance in the last 10 or 20 years. You'll deal with that in greater detail in later subjects, so in later, particularly financial accounting subjects. So basically, in this subject, we have a lot to teach you. So we simplify some of the income statement reporting by focusing on the main elements, which are the income accounts and the expense accounts. There are special types of income accounts called other comprehensive income, which we'll deal with in other subjects. So that's don't worry too much about that. So the statement of changes in equity is in effect the changes in the equity accounts, which actually totals to comprehensive income. Statement of financial position here, the third one, is, so this is the balance sheet. So that's at a point in time, usually at the end of the financial period, we'll be able to total up our assets, liabilities and equity accounts and understand the financial position. Now, finally, the statement of cash flows. So the statement of cash flows, which we'll look at in more detail later on, is that we classify our cash flows into three classes as operating, investing and financing. And then we, after classifying those cash flows, we'll give subtotals of all the cash flows, the cash that flows in the business and cash that flows out of the business in those three areas of operating, investing and financing. And that's over a period of time. Okay, any questions about our four financial statements? So here's an introduction to this is our balance sheet, our statement of financial position. So that reports the assets and the liabilities and equity. So one way of thinking about the assets are that they're resources to the business, and then the obligations and claims are the liabilities and equity. So this is actually a very important equation: assets equals liabilities plus equity. So this forms the foundation of the next couple of weeks, when we'll introduce you to debits and credits and bookkeeping and accounting. So we'll use this equation to classify transactions that involve our balance sheet accounts or elements. So the assets equals liabilities plus equity, and that always holds that equation. So here's an example of a statement of financial position. Often when I was learning accounting for the first time, it looks like you've got a lot of information there. Don't worry too much about it. The main point is that this statement is divided into three sections. So it starts with assets, liabilities and equity. So the assets are at the top, and then it lists the different types of assets. Then there's liabilities, and they're listed under that section, and then there are the equity section or equity accounts. And then in this case we only have two. We have share capital and retained earnings down the bottom. So that's just an example of what a statement of financial position looks like, or balance sheet. We'll get a lot more practice at building those statements and also creating them during the course. Now, a question you might have is, what do we mean by assets, liabilities and equity? So here's a definition of assets. So an asset, to define an asset, has basically three main elements to it. It's a resource controlled by the entity, and the event giving rise to the control of the resource has occurred. So it's not a future event; it's a past event has risen where we control resources, and also the resource has future economic benefits. So the future economic benefits often involve an inflow of cash to the business, or what's equivalent to cash. And so the three elements there, of course, there's the resource, we have control of the resource, and then the resource provides economic benefits. So they're the three. So that's a fairly broad definition of what an asset is. We'll look at some examples of assets today and during the course. So some examples are at the bottom there. So cash is an asset, and then supplies are an asset as well. So supplies might be inventory. If we're running the bookshop, then our inventory are books. So they give rise to future economic benefits when they're sold. There's equipment. So the equipment can be all sorts of things depending on the business. So equipment can be machinery, motor vehicles. There are properties. So properties can be real estate, can be land, and property, of course, can be a range of other different types of assets, which we'll look at. And patents there is an example of an intangible asset. So that's an asset which doesn't have a physical shape or form but gives rise. Probably a simpler example of an intangible asset would be a license. So if I had a license, I might have a license to... license might be to have a casino. So if I have a license to run a casino, then that license would be considered as an asset, because it's a resource and it has the potential to produce economic benefits. Other licenses might be a license to have a television station to transmit, or a radio station, so it's another type of license. Simple license could be a fishing license, so I might have the right to go fishing. So I might have the right to go fishing out in the seas and catch fish. So that's another type of intangible asset, a license. Any questions on our asset? Good question. So we'll cover this shortly. So the question is about assets. So the assets are classified as current assets and non-current. And so in what order do we produce or display or show the different types of assets? So in Australia, the convention is that we'll show the current assets and then the non-current assets. So, and Australia follows what's called the International Financial Reporting System, IFRS, and so let's have a look at the example here of assets. So current assets involve assets which are cash or cash equivalents, or converted to cash, or consumed within 12 months. So it's generally a 1 year period. And non-current assets are assets that continue to exist beyond 1 year. And so in this example, we've got cash, accounts receivable are current assets, supplies are generally current assets, prepaid insurance is generally a current asset, and office equipment would be the only possible non-current asset. So in the case here, we've got 4 current assets and 1 non-current asset. We'll deal with this in a bit more detail shortly about the distinction between current and non-current assets. Any other questions about assets before we go? Okay, yeah. So with the asset, the event giving rise to control has occurred. So example might be we might have purchased. I'm trying to think of something. We might have purchased property or inventory, and so we have a contract and agreement to purchase the inventory, and we haven't paid for it, but the inventory's been delivered. And so what we'll do is that we'll recognise an inventory asset because the supplier's delivered the inventory to us, and we have an agreement or a contract, a legal in force agreement. And so the events giving a rise to the control have occurred, being the agreement or the contract for the purchase of inventory, or we might have purchased some land. And so we have a contract for the purchase of land, and we might not have even paid the money yet. We might have taken out a loan to purchase land, but we will include the land as an asset once we have a contract and the contract's been executed, so the transaction's been finalised. So that's an event that's given rise to control of the asset. An example of where there's an event which it's a future event. So we might have an agreement for a future purchase of land or some inventory, but it hasn't been delivered yet. So we might say what we want to do is that we want to purchase a property, and so but we don't actually have a contract for it. We have an expression of interest or an agreement that later on we will actually complete the transaction. So it might be a future event. I think of something else. So it's something where there's not a completed contract or agreement, and we have an intention to acquire something in the future, but we haven't actually completed the transaction. So the event giving. So we don't have the control yet because we haven't completed the transaction. It's probably is that sort of clear enough for that? So generally, it's a completed transaction, and where we have a legally enforceable right to complete the transaction. Another example of where there's no control actually would be generally what you'll never see is that people, employees, don't appear as assets in the financial statement or in the balance sheet. And there's two good reasons for that. One is that there's no control. So generally, people are often very valuable to a business. So, for example, Microsoft had Bill Gates, or Facebook had Mark Zuckerberg as the CEO. So those people carry a lot of potential value, but they're not controlled by the company. So the companies themselves. So people are considered to be controlled. So because there's no legal slavery, if you like, that would be an extreme example. So we don't count people as assets of a business because they're not controlled. And so that's an example where there's no event giving rise to control because people actually can't be controlled or not considered to be controllable. Second reason, I'm going outside the course a bit now, is that the other reason that you'll see that people aren't considered as assets is that we can't measure their value, and we'll look at shortly the recognition criteria of an asset. There are two of them, and one is that there's the probability of future economic benefits, and we need to be able to reliably measure the asset. So there are some cases where we can't measure a resource, so we don't include it as an asset. And a good example of people. So to actually be able to say how much are you worth as an employee, it's extremely difficult to do that. So that's another example, at least, of why we don't consider people as assets. Okay, any other questions about our assets? So if we have a transaction pending, it'll depend on the stage of completion, so whether we can enforce completion. So we might have an intention to buy something, but say I might have an intention to buy a new television, but I go to the store and they're out of stock, so I can't buy it. So, I can't include the television as an asset because I didn't complete a transaction because, say, the store didn't have it in stock. So then, at a stage where I do pay for the television, and then I'm confident that it'll be delivered, then at that stage I might regard the television as an asset of the business if I'm buying it for the business, of course. So it'll depend on the exact circumstances of the transaction and whether I have a legal right to enforce it and complete it. Okay. Any other questions about our assets? Okay, let's have a break. So we've been going about an hour. So generally what I do is that I'll have a break for 5 or so minutes every hour, and we'll have a break now, and then we'll resume in about 5 minutes.
Because in real life, I work as a financial department under a stock company. So basically, what I found the most difficult part will be how to classify this cost will be belonging to this section or that section.
Oh,
that
cost.
section. Yeah,
Oh,
yeah.
okay. So allocating costs.
Yeah, yeah. So normally, like in the course as well, because like I used to, like I learned accounting before,
Yeah.
and I found the most difficult part is how to classify this money is belonging to the assets, equity, liability, something like that. Like this section is really difficult
Yeah.
to classify. So do you have any better method to, or you know?
So there's two things. You were talking about costs, so allocating costs. Two things. So that's an area of management accounting where there's an expense or a cost, and then we assign it to the production of an asset, and then we account for it that way. And so we'll include it as part of the value of the asset in our accounts. This is actually going. Later subjects will do this, where we have different ways of assigning outputs or expenses into the production of assets. So that's the more advanced management accounting, which we don't really have time to cover here. And you'll do it in management accounting subjects, where we allocate an outgoing or expense to the value of the asset working process.
Because I found that's a really tough task.
Oh, it is.
Like,
It is.
We got so many arguments like how
Yeah.
how this cost belong to this part and
Yeah,
this part.
and we might have electricity. So, what amount of the electricity cost do we assign to the production of inventory or
Something like that. Yeah.
Yeah, that's later subject. That's quite advanced, and you'll do it in management accounting subject. We can't really cover it here because there's so much more to do. Yeah,
Okay, that's good. Thank you so much.
welcome. Sure.
I'm confused about between the public owned and the private owned.
Okay, so the difference is the public-owned company is on a stock exchange.
Stock exchange.
Yeah, so people buy and sell on the stock exchange.
Not for the private company and the. I thought the publicly owned means the country have the.
No, so here I can understand that. No, public owned means that the people on the investors on the stock exchange own it. Yeah, so they're the investors.
So the private owned just means the stock
like a
shares cannot sell.
Yes, it's only the family, the individuals control the company. The small family business, for example.
Thank you. And the question is. And the individuals means the external companies.
So the individuals are managers, people. So just the manager, the CEO, executives that manage the company.
So this individual is not for this company. The entitled company is the external.
It's somebody that's employed. They're just employees to manage the company. So a manager that's not part of the family or the owner of the business.
Also, the separate.
Yeah, it's a separate person.
So the manager also, I think the company employee or manager control their company. So the manager also belong to the company.
No, the manager is just a specialist manager that is good at managing a company. So it's an outside person.
So financial report also for the manager.
It means that if there's a manager that's not an owner, it's more likely that the company should produce financial reports, because the manager might anyway. So there's a separation of the ownership and the management, and so that in that case, there's more likely to need information for financial reports, because if the owners still manage, then no one else is really interested in the company. So because the owners manage and they know everything about the company. But if I'm an owner and you're the manager and I'm the owner and I'm outside the business and you're managing, and so I want to know how the business is going. So
I should make the financial report.
Yes. So you, as a manager, you arrange the financial report and report to the owners, because the owners are no longer involved in managing the company. They're outside the company. Okay.
Okay, let's have a look at, continuing on from our assets. So we had the question before, actually this is a question I was talking about are people assets? And one of the reasons is it's difficult to measure. So for an asset, generally we have a resource that satisfies these three criteria. It's controlled by the entity, the event giving rise to the controls occurred, and thirdly there's the flow of economic benefits associated with the resource. So we can then identify an asset. But what also we need to do are two more things before we can record or recognise the asset in our financial reports. So an asset, so we might have a resource which we identify as an asset, but we need two more things before we can recognise the asset in our accounts. And those two things are that it's probable that there's future economic benefits associated with the item that flows to the entity. So it needs to be more than just a distinct possibility that this resource will produce economic benefits, usually which is in the form of a cash flow, a positive cash flow. And the second part is that the resource has a cost or value that can be reliably measured. So we need to be able to measure it. And so the example we looked at before are people. So people can be very valuable to a business, but they can't be reliably measured. So we're not going to recognise people as an asset of a business for accounting purposes. Okay, so the asset needs to not only be a resource that meets the definition or criteria of an asset up here, but it also needs to satisfy the two additional recognition criteria. That it's probable of inflow of economic benefits, and secondly, we can reliably measure that asset. Sorry. Okay, any questions on the asset then? Let's have a look at liabilities. So how do we identify a liability? So what the liability is that it's a present obligation, and the event giving a rise to that obligation has occurred, and the obligation involves an outflow of economic benefits, which is usually in the form of an ultimate payment of cash. So we'll identify an event that gives rise to a liability where it meets those three criteria. There's a present obligation. Now it's a present obligation of the business or the accounting entity or an individual, and the events giving rise to that obligation's occurred, and there's an outflow of economic benefits. So the event giving rise to the obligation has occurred. So this is probably, it's similar to the criteria for an asset, except it's in the reverse direction. So the obligation has to be a present obligation, meaning that it's not a possible future obligation. So where the events haven't given rise yet. So an example of an obligation might be that if I have an agreement to employ somebody. So I say that next month or even next week we've got a new manager arriving, and I'm going to pay the manager $1,000 a week. So, but at the present time we don't have a present obligation to pay wages or salary to the manager because the manager hasn't started work yet. So we won't recognise a liability until the employee or the manager has arrived and started work. So I might make the announcement that the manager will arrive and start work next week. So that's an example where it's a possible future obligation, but it's not a present obligation. Okay, any questions about our identifying liabilities? All right, so if we identify an event or a transaction that gives rise to a liability, there's two additional things that we need to satisfy. Again, we have recognition criteria for a liability. First, it's probable that there'll be an outflow of economic benefits or resources from the settlement of the obligation. So we eliminate or extinguish or settle the obligation, and it's probable that that will involve an outflow of economic resources. And we can also reliably measure the amount of economic resources. So we can measure or put a number on the probable outflow of economic benefits. An example of a transaction which might not satisfy liability because it might not satisfy the recognition criteria might be if you're here and you're paying student fees, or you need to borrow money, and you go to your parents or a family member, and you say, "Oh, my mum or dad, I need to borrow some money because I'm studying here in Brisbane," and they lend you, say they lend you $1,000, and then if you're a business, you might be able to recognise that as a liability where you borrow the money, but because it's a family arrangement, and it might be that your parents think, "Oh, well, we'll just make a gift and we won't ask for the money to be repaid." So that might be an example where it's not probable that there will be an outflow of economic benefits, that you will have to pay back the loan. So in that case, you wouldn't recognise a liability if you can indefinitely defer repayment forever. So that might be an example where you don't recognise a liability if you've borrowed money from a family member. Okay, any other questions? Any questions about our liabilities? Now, so we've looked at assets and liabilities, and the other main section of our statement of financial position or balance sheet is the equity section. So this is equity is generally measured as the assets minus the liabilities. So if we remember, our accounting equation was assets equals liabilities plus equity. So we had assets equals liabilities plus equity. So that's our accounting equation. So the equity can also be measured as the assets minus the liabilities. So that's just the measurement of equity. There are generally only a limited number of accounts which are recognised as equity accounts. Commonly the main one are the resources provided by the owners. So it might be owner's equity if it's a sole proprietorship. And we'll look at some examples of this later on, so don't get too worried about it. The other one common is share capital or stock capital, and that's for a company that issues shares, that's the money that's used to purchase shares in the company or stock in the company, and so that's an equity account. So that's the fund contributed by shareholders there. The other one is retained earnings. So what we'll see later on is that the retained earnings is the amount of generally the profits from the business. So the net profit from the business, the accounting for that is, we'll see this later on, is that the net profit is transferred into what's called retained earnings. Sometimes that account's called retained profits. So retained earnings is the amount of money that's transferred into that equity account from the net profit. So that's the income minus expenses that we produce in our statement of financial performance or our income statement or statement of profit or loss. So that's what retained earnings is. That's an equity account. And the other one is reserves. So we have a number of different accounts called reserves, and there's a common one called general reserve. And we'll see there's not a lot of guidance in the accounting standards on what we classify as reserves. There's some specific types of reserves. We'll touch on later on when we look at the equity section of the balance sheet in a few weeks' time. One of them is an asset revaluation reserve. We'll look at that when we come to valuation of assets. We'll create a reserve sometimes when we revalue an asset. The other one is a foreign currency translation reserve. That's a very specialised reserve. We don't really need to go into any detail about that. That arises where we have a case where if we're a business, say in Australia, and we have operations overseas, say we have operations in China, and so if I'm operating in China, and of course I might be earning sales revenue in renminbi, and I'm reporting in Australian dollars, so then I might recognise the sales revenue not in Australian dollars, but it occurs in renminbi, the Chinese yuan, I think it is. And so then the accounting for that would be that I might immediately recognise sales revenue, and I can use the foreign exchange rate to recognise Australian dollars. And then at the end of the financial period, I have some assets. Also, the cash might still be sitting as cash it might be in my Chinese bank account with Bank of China, and it's in renminbi. So at the end of the financial period, I have to count the cash, and then I use an exchange rate to count the cash, convert to Australian dollars. And because there might be a timing difference between when the sales revenue occurred and I accounted for the sales revenue, and the cash asset gets counted at the end of the financial period, that the exchange rate shifts. So this is actually quite complicated, and you don't need to really worry about this, but if you want to understand a financial currency translation reserve, it involves a movement in the exchange rate between the time of, say, a sale and the recognition of the cash asset at the end of the financial period, where it's converted to Australian dollars, and a movement in the foreign exchange rate between those 2 points in time can give rise to a foreign currency translation reserve. Anyway, you don't need to know that level of detail anyway, so that's just what it is. And we'll look at asset revaluation reserves when we revalue assets in a few weeks' time, when we look at the assets section of our balance sheet. So that's the equity section. Okay, any questions on equity? There's not a lot of detail there, but we'll look at it more in a couple of months' time when we look later on in the course. Okay, let's do a lecture exercise. So we've got some information here, and we're asked to prepare a statement of financial position as at the 30th of June 2019 for a business company called Bricks Limited. So we've got some accounts there, and we've got some amounts, some numbers there. So we're asked to produce a statement of financial position. Sometimes they're referred as the balance sheet. So we're going to need to identify which of these items or accounts are assets, which are liabilities, and which are equity, and then we'll need to classify them and sort them into the right category. So the first part of the process is to identify which of these accounts are. So the first job is and we'll get better at this over the next few weeks when we get some practice of this. This is a difficult exercise for week one, so I understand that. So a bank loan when we borrow money it's a present obligation, which will involve an outflow of economic benefits, so it's a liability. So the bank loan or a debt or a borrowing is a liability. Share capital, which we just looked at the previous slide, is an equity account, so that's equity. Accounts payable is commonly an account payable would be where we've done a transaction, we've purchased goods or services, and we owe money. We didn't pay cash at the time of the purchase, so an account payable will be, this is us in the business, we've purchased goods and services, but we owe the money. We didn't pay the supplier, so we'll recognise an account payable. That's a liability. So we have a present obligation to pay for some goods or services that we've acquired. So the account payable is a liability. Taxes payable it's similar in that we'll recognise that we owe tax, generally to the tax authority. So we'll recognise a liability for tax that we owe, and we create a tax payable. That tax payable liability, tax payable account item is a liability. Inventory is an asset. So inventory is an example of inventory I talked about briefly before is the bookshop, I think the book locker. So the book locker has books, and so the books are inventory, and so that's an asset because it'll produce future economic benefits. When the book locker sells the books, there'll be an inflow of cash. So that inventory, the books, is recognised as inventory. Cash, the next one down, is an asset. So we'll recognise the cash as an asset. Land and buildings are generally regarded as having potential to produce economic benefits in the form of rent cash when we rent out. So we'll recognise land and buildings as assets. Retained profits, we saw in the previous slide, is an equity account. So we'll classify that as equity. And then finally, accounts receivable. So accounts receivable is where we sell some goods or services, and so we didn't receive cash, so we have an amount that's owing to us, that's receivable by us. So that's an asset. It's an accounts receivable is an asset. So that's an asset. So now we go through and we'll classify those into each into respective items. So this is just the problem reproduced again. So for the problem, prepare the balance sheet as for the company. So and then we've got some information about retained profits. Give us a look. Oh, okay. So we're going to have to produce. We'll do the first part is just to produce the balance sheet first. So once we've classified each of those, we put them in the right section, and so that's what it'll look like here. Is that if I can expand that out a bit. So this is, we've just classified those items as assets, liabilities and equity, or shareholders' equity. So in the assets there, we've got the cash, accounts receivable, inventory, land and buildings, and then we've added those up for total assets. So and then the liability. So we've just basically reassigned these accounts here and put them in to the three sections. So the assets are the cash accounts, land and buildings, and we've totaled that up to get our total assets, 800,000. In the liabilities, we've got our accounts payable, taxes payable, and the bank loan, and that'll give us total liabilities of 200,000. And then the other two accounts were share capital and retained profits. So I'll just double check that those numbers are the same up here. So here's, so share capital was here. I can't highlight, there it is. And retained profits was there. So we go back down. And so we have the total equity is 600,000 there. So all we've done is just rearrange those accounting items as their assets, liabilities and equity. And the other thing we do, of course, is that we remember that our accounting equation, so our accounting equation, assets equals liabilities plus equity. So we just check whether that works out as well. So total assets are 800,000. And then we have our total liabilities of 200,000. And total equity is 600,000. So we have, and the other, sometimes there's a subtotal here which is not so important for our purposes right now, but the assets minus liabilities is referred to as net assets. Sometimes you'll see that. net assets is the assets minus liabilities, and which will equal equity. So here we have the our total assets equals our liabilities plus our equity, 800,000 on both sides. Okay, any questions about that, our statement of financial position there? I'll do the last line in a second, so I just want to check if there are any questions about our balance sheet there. So it did involve a lot of, we had to work pretty hard because we had to, we're not familiar with classifying those accounting items as assets, liabilities, equity. We'll get better with that. I have to practice in the tutorials over the next few weeks. So that's the balance sheet, what it looks like. Any questions? The second part of this problem asks us to work out the profit. So this is actually pretty advanced for week 1. So but let's go back and we'll revisit the dealing with retained profits or retained earnings later on in the course. But here we've got information is the retained profits was 200,000, and then what we're told here is that the balance of retained profits was 180,000. So there's a difference here between the 200,000 at the end of the financial period and at the beginning. And what we'll see later on is that we transfer our net profits from our income statement, our statement of profit loss, into retained earnings. And so we account for the difference between the 200,000 and the 120,000 the difference is 80,000, and that's equal to the net profit for the period. So the net profit for the period is 80,000, and that accounts for the difference in retained earnings. The other side issue to this, which makes it even more complicated for us in week 1, is that when we look at this, when we look at dividend payments later on in the course, is that dividends are generally paid out of retained earnings. So, and in this problem, we were told there were no dividend payments. So the only difference between our retained earnings was the transfer of net profit for the period of 80,000. Okay, any questions on lecture problem 1? The main task here is getting familiar with the accounting items and being able to classify them as assets, liabilities and equity. We'll get better at that in the next few weeks when we do a bit more practice. Okay, let's go back to our lecture. So that was the lecture exercise 1. And so we've just finished working our way through the statement of financial position, looking at assets and liabilities. Let's have a look at a bit more detail at the statement of profit or loss. Or I'll refer to this as the income statement for convenience. Just that's a bit easier to say. So the statement of profit or loss is, it's our second main financial statement. We've just looked at the statement of financial position or balance sheet. So this is the purpose of that, is to measure performance. So we're going to measure whether we made the difference between our income or revenues and our expenses. And so what we do is that we count our income, which are revenues and gains, and we deduct all the expenses, and that gives us the income minus expenses is our profit. So the profit is a positive number where the income exceeds the expenses. Where you see loss, that means is that the expenses were higher or greater than the income. So when you see a loss, generally that will mean that the expenses were more than the income. Most of the time we'll see a profit, because most businesses make a profit, because in the long run you need to make a profit, because not only do you need to pay your expenses, but you'll generally also need to give your owners some dividends or some payment in the form of a return to the owners of the business. So some businesses in their early years will make losses because they're starting up and they haven't, if you like, reached their potential to raise for sales. But in the long run, businesses need to make profits and to stay in business. Okay, so the statement of profit or loss, and this is our next major, after our accounting equation, assets equals liabilities plus equity, net profit equals income minus expenses. And then what we'll do is that we'll transfer this net profit into our retained earnings later on. We'll look at the accounting for that later on. Okay, any questions on our statement of profit or loss? So let's have a look at, this is just an example of what a statement of profit or loss would look like for a business. In this case, it's Wong Limited. So this is just for 1 month period. They have service revenues, so these are income, the service revenues, $10,600. And then we have a list of expenses here, which I can't say. So there's just a number of expenses. So generally the convention for our statement of profit or loss is we'll list the income or the revenues at the top, and then underneath that we'll add up the expenses. And in this case the expenses are in decreasing order of size. So we've got the largest expenses as listed and then the smaller expenses underneath that. Then we total up the expenses and then we calculate our profit after deducting the expenses. We've also done a little bit of extra accounting for tax here because we've got the profit before tax, which is $4,860. And in this case we've got the example here, we've got our tax expense is $2,000, and so we deduct that as well in order to work out our overall profit figure, which in this case is $2,860, which has got the number 1 next to it there. Okay, so that's just an example of our statement of profit or loss, which lists our revenue. In this case we only had service revenues. Deduct all the expenses to get our profit. We've also deducted our tax expense in this example. Okay, any questions on? Yeah, that's a good question. There's no gross profit, so we'll look at this in week 4 when we look at a retailing business. So in week 4 we'll look at a retailing business, and when they account for their statement of profit or loss, they have another expense item. It's called cost of goods sold. So in this case it's a service business because we've got service revenue. So service revenue might be an accounting firm. So an accounting firm produces sales revenue by selling its accounting services. So it'll recognise service revenue, and then it won't have any. It won't sell goods because it's producing services. So which is the value of the accounting services from the accountants in the business. But if it was and we'll look at this in week 4. If it's a retail business, meaning like the bookshop, it will sell. The expenses includes the value of the books that are sold, and that's called cost of sales or cost of goods sold, and that's an expense, and it's also listed there. And the special accounting, when we look at what we call a retailing business, selling goods, is that we'll recognise the cost of goods sold being the value of the inventory sold by the business, and we deduct that from the income, the sales income, to have a gross profit figure, which is an interim profit figure, which just tells us how much money we've made solely after deducting the cost of inventory sold or cost of goods sold. So we'll look at this in week 4 in more detail. It's just a simple example because here we are. We're just introducing ourselves to a statement of profit or loss. Okay, any other questions? Yep. Good question. So net profit is generally after tax. So where you see net profit, you can generally assume it's after tax. So a lot of simplified examples won't introduce tax, won't have a tax expense in their list of expenses. So, but in the real world is that most businesses will be liable for income tax on their income, and where we operate, because we're introducing a lot of new information, we don't deal in a lot of detail in tax expenses or the tax. So, but Generally, for a business, they're taxed on their income here, which sometimes is different. So we might see a little bit here, but we'll do in later courses, is that the revenues that we recognise as income can be different from the assessable income that the tax regime. So there's a whole list of tax laws out there which sometimes have a slightly different treatment from our accounting treatment, and because they might recognise certain amounts as different, and that's a function of the taxation laws. So sometimes the tax laws have special treatment for accounting items, because sometimes in the business we often try and minimise our tax, because we'll be liable for tax, and that's sometimes a major expense, and it affects the profit of business, and also affects the dividends we pay shareholders, affects the return that we earn as an owner of the business. So often our job is to minimise our tax, and we often manage our business and manage our accounting for that purpose. And then sometimes there'll be a difference with the taxation. So the taxation laws will recognise that accountants have been doing this for 100 years or longer, is that they're trying to minimise. So they'll have special provisions for tax purposes. Your income might be different from the accounting income. So this actually, you'll cover this in later subjects. That's actually that's a good question. It ends up being quite advanced. So for our purposes, we're not so concerned about what the tax laws do. We just accept a tax expense as a tax expense and then deduct that to end up with the net profit for the period. Okay, I've actually given you a lot more information than you need to know anyway. But that's just one of the reasons why studying accounting is potentially quite valuable. Is for you personally, is that later on in life you could be an employee, you could be running a business, you could be providing advice, and you could be working as a tax consultant for one of the big accounting firms. And then you'll enter a world where the accounting treatment, the tax treatment, because the tax laws end up being different, and so you need to, of course, become aware of those issues. And also in accounting, it'll help you identify revenues, income, and expenses when you produce your own tax return as well. So it's one of the other side benefits of studying accounting. It will help you manage your financial affairs, of course, because you can understand financial reports and financial information, and also help you with your taxation affairs as well. Okay, any other questions with our statement of profit or loss? Let's move on. So now the question is, we looked at what is income. So we looked at when we looked at the statement of financial position, we looked at what's an asset, what's a liability, and what are equity accounts. And so here we are in our statement of profit or loss. We've got income minus expenses equals the net profit. So what's income? So generally what we mean by income, we'll recognise income where there's an inflow of economic benefits, which is usually often in the form of cash, and it's recognised as either an increase in assets or decrease in liabilities. And the net result is that there's an increase in equity. And there's an exclusion here, is that it's not a contribution by an owner. So it's meaning that if the owner, the third element there is that the owner doesn't add money to the business, so that's owner's equity or share capital if it's an investor. So that's not regarded as income or meeting the definition of income. So the other element here is sometimes it's difficult. Sometimes it's difficult to understand what's the difference between an asset and income, because assets often involve the inflow of economic benefits, and here we see income involves an inflow of economic benefits. And so sometimes at the start where it gets a bit blurry. So let's just go back to our accounting equation. So if we have, I'll just produce it, assets equals liabilities plus equity. So the example of an asset, get different colour text. So often with an asset, we'll see that if I purchase an asset using cash, then my assets will go up here, and also I could have two situations. If I pay cash, I'll have another asset going down. So I'll pay out cash. So cash will go down, and if I purchased property or plant and equipment, another asset will go up. So the net effect on my accounting equation is it's basically unchanged. So there's no change in assets because I have an equal amount of change. An asset goes up, one goes down, and so there's no change in liabilities, no change in equity. So that's in our accounting equation, the effect of a cash purchase of an asset. So it's an asset transaction. With revenue, when we recognise revenue, so just go back. I've got the wrong slide here. So the key thing here is that in the second point is that there's an increase of assets or decrease in liabilities that result in an increase in equity. So this is a key thing to help us identify if a transaction involves income, or was it an asset transaction purchase. There's an increase in equity. So if I convert it to my assets and liabilities equity, so there might be, so if I do a sale, so we looked at when I account for a service revenue or sales revenue. So if I sell something, then I get cash, and I'll use an example where I get cash for it. So what I'll have is an increase in cash. So this will be cash. If I do a cash sale, cash revenue, they'll go up, and then there's no change in any other asset. So if I'm working at the lolly shop and I sell some lollies, so I'm running the lolly shop, I'm the owner of the lolly shop, I get cash, so cash, and then actually that's not such a good example, but anyway I'll keep going with that. So I get cash coming in, and I recognise there's no change in assets because there's no real outflow in anything. Actually, I do have a little outflow of some lollies, so I've lost some inventory. But generally the amount of cash that I got is greater than the value of the lollies that I sold. So I've got a gap between the cash inflow and I'll write it here. So there might be a really small inventory. So sorry, that's bad handwriting, but that's inventory. So I've got a little inventory outflow for the lollies, and I've charged a lot of cash because I know students here love lollies and love sweets, so they'll pay more money than the value of my inventory. So there's a difference between the cash inflow and the inventory outflow where I sell my lollies. So we have to account for that because this accounting equation always holds. So what we'll end up doing is we'll recognise some income here. So there's an overall inflow of economic benefits which we'll recognise as sales revenue. So which will account. So the effect of the transaction is there's an increase in equity. So that's one of the things that would help us identify in what circumstance if we acquired an asset where we've got equal changes in assets, or there would actually, if we borrowed the money when we purchased an asset, there would be an equivalent change in a liability. But here where we can recognise income because the overall effect of the transaction is that there's an increase in equity. I know it's a little bit abstract, and we'll get a little better at when we get some sales and income transactions later on. Okay, any questions on that? Now income will just get a little bit complicated, or for a moment, is that there's two types of income. So most of the time we're talking about revenue. So we looked at sales revenue or service revenue, where we sell goods and services. And there are other forms of other events which give rise to recognition of income, and they're called gains. So the gains are often not regular transactions like income. So like revenues. So revenues are regular, so sales revenues are regular transactions. So gains might be where we'll recognise a change in the value of an asset, and we'll recognise an asset. Well, So that's another type of income, and it's called a gain. Yeah, the simplest one which we'll look at later on in the course is sometimes we'll revalue our assets and we'll recognise a gain on the increase of an asset, because one of the things we'll look at later today is that when we record transactions, if we purchase an asset, we use the current cost or current value of the asset, the purchase price, and then over time the value of that asset might change. So in accounting we can revalue our assets, and where we do that, where we recognise a higher value, we'll recognise a gain, which is an increase in generally in one of our non-current assets. Okay, any questions on our income, revenues and gains? Now, expenses. So expenses in some ways are similar to the opposite of income. So when do we recognise an expense? Is that we have an outflow of economic benefits, and the effect of the outflow is generally there's a reduction in assets, so such as we pay cash when we pay an expense, or there's an increase in liabilities. So we'll recognise a liability, which is a present obligation to pay out economic benefits in the form of cash. And that result in a decrease in equity, and it's not a distribution to an owner. So it's not an owner being paid dividends, or not an owner withdrawing cash from the business. So again, the effect of the transaction is that the key difference is that the effect of the transaction is that there'll be there's often an outflow of cash when we pay an expense. So an expense might be salary or wage expense. So if we pay our staff, we'll recognise an expense. Of course we pay our staff cash, and then the net effect of that there'll be a decrease in equity. So there'll be an expense, so that's how our accounting equation will function. So in some ways it's the opposite of income, where there's a net increase in equity with another type of expense. Might be could be electricity expense, internet expense, could be lots of advertising expense, lots of expenses which don't involve any other changes in assets or liabilities. And particularly in this case we pay cash, so the net effect of recognising expenses, there's a net decrease in equity, which will help us identify whether a transaction is an expense. Okay, any questions on our expenses? So we actually have, similar to income is revenues and gains. Expenses we have two types of expenses. There's what I think of as an expense in the normal course of business. So there's the cost of sales, which I briefly talked about before. This was the retail business. So that's the value of the inventory that goes out of a business when we sell inventory. There's wages expense or salary expense, telephone. Depreciation is a special case we'll look at later on the course. So depreciation is where we use up a non-current asset and we'll recognise an expense because we're using up economic benefits in an asset which lasts for more than 1 year. So we'll look at that in more detail later. Another type of expense is an interest expense. So we might borrowed money and then the bank says you have to pay interest, it might be every month. So we'll recognise an expense there. There are some other types of expenses or losses. So this is similar. These occur less frequently. A loss it's the opposite of a gain in some cases, such as an asset might reduce in value. So an asset might have gone down in value since we purchased it. So one way of dealing with that is to recognise a loss. So we might have bought inventory. So I might have bought inventory and then there was might be a special coloured t-shirt or something, and fashion changed or technology changed. So I might be selling iPhones and then Apple come out with a new iPhone, but I've got inventory of old iPhones, and so I'll recognise a loss because the value of my inventory's gone down because of the change in technology. So then I'll recognise a loss in the value of that inventory, and so that's another a less frequent type of expense, but nonetheless, it's still an expense because it's an expected outflow of economic benefits. Other types of losses, there's some examples there. Fire or flood, so natural disasters, there might be a flood, and so there I might recognise a lower value in some of my assets because it might be property or a building which has been flooded or might have been set on fire and destroyed. So that's another example of a loss. Okay, any questions on our expenses, losses? All right, takes us to lecture exercise 2. So we've got prepare a statement of profit or loss for the period ended 30th of June 2019. So we've got some information here. We'll go through these items one by one. So sales, where you see sales, it's generally short for sales revenue. So sometimes the example or the book or the tutorial problem will tell you sales revenue. Sometimes it's shortened to sales. So that's sales revenue and that's an income account. Cost of sales, which is, as I said before, is an expense account. So cost of sales is where its simplest example is the cost of inventory sold or cost of goods sold. So with a bookshop, where the inventory goes out at the time of the sale, we'll recognise an expense because that's an outflow of economic benefits. Wages expense, and we've got electricity expense, travel expense and advertising expense. So in this case we've got one form of income, the sales, and we have 5 different types of expenses. So let's have a look at, there's the problem again, let's have a look at the answer here. So now if I can find... So this is an example, actually follows from the question we had before in the front row here about the costs where we have a gross profit. So this is a bit more complicated than we need, but it's an example here where we've got an income, it's called an income statement, it's a statement of profit or loss, and where we've got the sales revenue, it's the top item, so by convention we have the income statement at the top. And then we deduct the first expense is the cost of goods sold, and it's often a major expense for a business that sells goods or inventory. And then we've got a subtotal here called gross profit. So this just tells us how much money, what's the difference between the actual revenues and the value of the item sold. So that tells us the price of the inventory, the price that we sold it for, less the price that it cost us. So it tells us, if you like, it's like a margin, the margin between how much the item cost us to purchase and what was the selling price. So it gives us some good, useful information to know because, of course, different items will have different margins, difference between their sale price and the cost of the business. And so that's a gross profit. And in this case, it's $27,000. And then what we do is we deduct the other expenses, and we call them operating expenses because they're in the normal day-to-day operations of the business. And in this case, we've got $15,000 of expenses. And then that'll give us, it'll give us a net profit number. So in this case, it's called net profit before tax. We don't have any tax expense information here. So that's, if you like, that's our end number. If we're operating in a world without taxes, then that net profit figure would be our final number here. Okay, so it's a little bit more complicated than particularly for week 1, but it's an example of a statement of profit or loss for a retail business where there's a cost of goods sold expense, and we've got some information there about the gross profit. Okay, any questions about that? Well, let's have another break. So we'll have another break for about 5 minutes, and then we'll come back and we'll finish off.
which kind of categories?
Yeah, that's a pretty tricky problem. It's we didn't. Yeah, that was a hard problem because it didn't give us much information. So that involves working out the profit for the period. So
So
what I didn't write out, which I probably should have done, is that she'll have retained earnings. So retained. So this will be the opening. So at the beginning of the period, so that'll be I think it's the 1st of July. So the retained earnings will add the profit. We deduct dividends, and that'll give us our closing retained earnings. And that'll be 30th of June. So in the case here, we were told that the retained earnings were they were 200,000. At the 30th of June, they started at 120,000, and we had 0 dividends were paid out, so the profit must have been 80,000. So that's equals.
yeah, I just thought that these numbers are come from the
So that's actually very difficult for week 1. So I did, but yeah. So that's the explanation of
may I
why.
keep this?
Look, I'll show it to everybody. I better show it to everybody at the end of the break. Okay, but at the end of the lecture, you can come and take it if you like. Okay. Yeah.
For the perfect, we just use the end of the RP to just read the
So yeah, I just answered that with this lady before. So what we had is the retained earnings were 200,000, and we have information they started at 120,000, and so the difference is the profit of 80,000 accounts for the difference between the two. And we told us there were no dividend payments.
Okay, thank you.
So yeah, I'll explain this after the break.
Okay, let's move on. Okay, now we're going to have a look at the statement of changes in equity section. This is actually very complicated for week 1, but I'll go back a step to see if we can explain this a little bit differently, and also I'll go back to that first exercise problem as well, and that was a tricky problem for week 1, so I'll actually go back and what I had a couple of questions during the break which were very good, and I realised I was cheating you a little bit. I didn't explain everything that I could have properly because we have a lot to cover, and I was trying to take a little shortcut there, but the questions were good because it made me a bit more honest now about explaining things, because we're going to deal with this in later weeks, but it's good to know this now anyway. So what I've said is that, actually I'll go back a step. Remember income expenses. The effect of income is that income will end up having an increase. The effect of an income transaction is that there's an increase in equity, and then, so this is income. The effect of income is there's an increase, and the effect of an expense is that there's a decrease in equity. So the effect of income is to increase equity. In our equity equation, the effect of expense is to decrease it. So that's the definition of income and expenses. Now, the net effect of, we take all our income and we deduct all our expenses, we end up with a net profit or loss. And so what we end up doing, I'll assume it's a profit, so we transfer this profit into equity, and this actually goes into retained profits. Retained profits. So into that equity account, we transfer. So we'll do the accounting for this in 2 weeks' time, when we're looking at closing entries. So this is a bit of a preview, but it helps us get an understanding of the linkage between this is our statement of profit and loss, and this is our balance sheet, or our accounting equation. And so they're linked because we'll transfer the net profit, or in this case, I'll call it a net profit, into retained earnings, into equity there. And that's partly because of this definition of income results in an increase in equity, and an expense, the effect of an expense is a decrease in equity. So we account for that. And we generally do that at the end of the financial period, because this is a measure of performance over a financial period, often a year, could be a half year. And so we wait to the end of the period to calculate our profit or loss, and then we do this transfer in accounting terms, which we'll do it in 2 weeks' time. We'll do the actual journal entry for that, which is called a closing entry. So that's the process, linking our two accounts. And so staying focused on our retained profits account. Now, retained profits account will change because it will have an opening balance at the beginning of the period, and it will change when we transfer profit or loss. And so in exercise 1, we constructed our statement of financial position, our balance sheet, and there was that little question at the end, which is quite tricky for our first week here, and we had information that our retained earnings was $200,000 at the closing date, 30th of June, and we had information the retained earnings opened $120,000. Now we'll look at this is another equation which we'll look at in more detail when we look at the equity section of the balance sheet. I think it's probably week 7 or 8. And so we adjust our retained earnings by adding our profit, or this could be a minus if it was a loss, and we also pay dividends out of retained earnings, which we'll look at in a few weeks' time, as I said, when we look in more detail at the equity section of our equation. And the problem said there were no dividends, and so to reconcile or account for the difference between the opening balance, $120,000, and the closing balance, we worked out was a profit, because we transfer the profits into retained earnings, and so that gave us the $80,000 there. Okay, so that was the answer to that little ending part of exercise 1. And that follows on from our general process here, where we transfer net profits into retained earnings, or it's retained earnings. Sometimes it's called retained earnings. That's the old title for it. Okay. Any questions on that? Let's press on, because the other thing that this statement of changes in equity, what it does represent is that it represents the net effect of all our changes in income and expenses for the period, and it's also influenced, of course, by changes in the asset values and the liability values, and so which takes us on to our next slide here. Is that the statement of changes in equity? It's another financial statement, and it gives us more detail about the changes in all our equity accounts, the share capital or owner's equity, the retained earnings, and any reserves as well. And so what it's regarded as reporting is the total income for the period, in effect being the... So another way to think about it, which is quite advanced for our purposes for week one. What have I done here? Got the wrong section. So because it represents, if you like, I've lost focus here. So it represents the total income, net profit change. So another way of thinking about the statement changes in equity, it reports the net effect of all the different what's called total comprehensive income. That's pretty advanced because we won't deal with comprehensive income in any detail in the course because we're focused more on the main income statement or statement of profit and loss transactions. The other thing that occurs is that if there's some adjustments to accounting policies and standards or errors, we'll make adjustments in the equity accounts as well to account for that. So we'll look at this later on in the course as well. And statement changes in equity also details transactions with owners, and that in effect is the payment of dividends. Dividends are taken out of retained earnings, and also if it's a sole proprietor of course just has what's called a withdrawal. They withdraw funds out of equity, out of retained earnings. So that's if you're starting your own business. And for example, if you're starting your own business, you'll add some resources or money into the business called owner's equity. So it's not share capital because share capital generally refers to shares or stock. So as an individual sole proprietor, you'll have an account called owner's equity. It's the value of your resources might be cash or some equipment. And then over time, you'll need to buy food and maybe pay rent or something. So you'll take money out of your business. So you'll actually take money out of the owner's equity as well. So that reports the transaction with owners of the company are in the form of payment of dividends for shareholders or the withdrawal of funds from an owner of a business. Okay, any questions? So that's just an overview in brief introduction. Let's have a look. So here in pictorial effect is the statement of changes in equity. What it does is that it shows the revenues and the expenses, and then the payment of dividends or investments stockholders. So the increase is actually just the payment of cash for share capital by stockholders. Okay, there. Let's have a look at, here's an example of a statement of changes in equity. So at the top is the different equity accounts. So contributed equity is the share capital, and then the capital profits is the retained profits or retained earnings. So they've used slightly different accounting names there. So this is actually a pretty complicated example just to illustrate a statement of changes in equity that comes out of the textbook. So the reject shop is that retail store, and basically what it does, it has an opening balance and a closing balance. So what they do is they just provide more information for users of financial reports to understand why did each of those equity accounts change. And so it provides some interesting and useful information for users of financial reports. It's generally not the main financial statement that users are interested in, because users are often very interested in the income statement. Did it make a profit or loss? And then also the balance sheet or statement of financial position. What are the various sizes, assets, liabilities and equity. So this is just providing more information about those changes in equity. That's a very complicated example, so I would say there's no need to remember anything in that slide. So here's the different accounts. So statement of changes in equity has the net effect of, it adjusts the retained earnings from that transfer of net profit or net profits or loss, and then it also accounts for total changes in comprehensive income. Again, and as the bottom of the slide says, you'll get to study that in more detail in Accounting 7102. So don't concern yourself too much with this issue of comprehensive income, particularly other comprehensive income. The background to comprehensive income is that for the last 80 years, people have been debating how do we best measure performance, financial performance of a business. So at the very traditional, at the very start of the accounting time, say 80 years ago, it was simply we had revenues minus expenses, and that gave us the net profit or loss for the period, and that was a good measure of performance. And so over the last 80 years, probably the last 40 years in particular, there's been a recognition that there are other items such as gains and losses should be reported as well. So the debate has been slowly in favour of increasing the number of items that go into measuring the performance of a business. And so this has given rise to what's called comprehensive income. Comprehensive in the sense it's more comprehensive, it includes more items. So that's the background to that. But as I said, it's covered in more detail in later courses, and we don't need to worry ourselves too much about it. Okay. Any questions about our changes in equity? Let's move on to our last statement, which is a statement of cash flows. We'll spend a whole week on this later on in the course. So this is basically an introduction, and the main purpose is to give us additional information for users of financial reports, financial information, and it gives us supplementary information that what doesn't appear in the balance sheet, doesn't appear in the statement of profit or loss, doesn't appear in the statement of financial position, and it actually calculates transactions in cash, so they're cash inflows or cash outflows, and what's the net change in cash of the business, so we can understand why cash has changed. So here's an example of a statement of cash flows. It's a fairly typical statement. So we classify. We'll see this probably in about 9 weeks' time, probably 10 weeks with the break and other things going on. Is that the cash flows are classified into 3 activities: operating, investing, and financing activities. And we'll calculate some new items, new cash flow items. And the example is cash receipts from operating activities. So that's cash received from customers or cash collected from customers. And then we'll just add and subtract all the cash flows in and out, and then we'll have a net figure at the end of the period, which is the cash at the end of the period. And so in this case it's $15,200, which gives us not only the net change in cash, but also in which types of activities were there different cash flows, and that gives us some additional information for understanding the company and its cash flows. Okay, any questions on that? We'll cover this in a lot more detail later on. Now here are the interrelationships between the statements. There's actually 2 relationships here. I'll go back to the last slide. So what this statement of cash flows does, it calculates what's the net change in cash. And what we'll see is that if we go to the statement of financial position or balance sheet, if we have 2 years, we'll see the change in cash went from one number to another. And so the statement of cash flows should equal that, so we can reconcile or account for the change in the statement of cash flows, the change in net cash, with the change in cash in our assets in two balance sheets. So there's a small relationship between the cash reported in our assets in our balance sheet and the net flow of cash, an increase or decrease from that statement of cash flows. So that's in this slide here. So the second statement is the statement of cash flows is linked to our cash balance, our changing cash assets in 2 years, from 1 year to the next year. The first relationship is the one I described here, is that basically this diagram here. So this is our income statement or statement of profit or loss is related to the statement of financial position or balance sheet by the transfer of profit or loss into retained earnings, which sits in the equity account. So that first statement there is the link there from that flow diagram on the overhead projector there. Okay, any questions on that? Oh, you'll jump 10 weeks ahead. That's a good question. So there are two methods of calculating cash flows. There's a direct method and an indirect method. You don't need to know anything about that until we do it in week 10, I think it is. So, yeah. So there's two ways to calculate this operating cash flows. We can calculate operating cash flows using a direct method or indirect method. You don't need to know this until we actually study it, because it's probably... Because we study it in the second half of the course, it won't be covered by the mid-semester exam. It'll only be, if it's covered, it'll only be examined in the final exam. Yeah. So, but there's two ways to calculate operating cash flows. There's a direct and indirect method. Any other questions on our financial statements? All right. Good. So here's an example of, this is just another illustration of the link there. So what we've got here is we've got the balance sheet is in the left column there, statement of financial position. We've got the income statement on the right, and then we've got our calculation of retained earnings. So that bottom statement is here. So this calculation, this formula here, is reproduced at the bottom of this slide here. So that the calculation of retained earnings is down the bottom. That bottom square there is the opening retained earnings, add profit less payment of dividends to get the closing balance of retained earnings, and then that change in retained earnings incorporates the net profit, which is on the right-hand statement there, which is the income statement. And so in a sense, the net profit for the period on the right there updates the amount of retained earnings, and then it gets updated there in our balance sheet on the left-hand side of that slide. So that's actually, it looks complicated, but it's only really just it's only in effect explaining this flow here, the net profit going into retained earnings there. Okay, any question? Oh, we've got a bit more about, well, let's have a look at. And the second thing is that the second interrelationship here is just the statement of cash flows. The net cash flow, inflow or outflow, is represented by the value of the cash asset in our financial position there. So that's a simplified example, actually. We'll deal with that in more detail when we look at the statement of cash flows in detail. All right, so that finishes describe the major financial report, or we've just described our four main financial statements here and looked in a bit more detail at the different elements. That's a loud ring. And so now we'll finish off looking a bit more at some characteristics of financial reports. So this is a mixture of some accounting information here. The what financial reports do is they're prepared by the managers, the accountants that work at the business. They're provided to external users for general purposes, so they're general purpose financial reports. The other asset factor is that it's all past information, and it doesn't tell us about the future information. Often the past profit figure might have some information about future performance, but not necessarily. So we have this question of regulation of financial reporting. So why do we have a world where we have regulators? Why is anyone interested in this anyway? And so one of the reasons is that we have people relying on financial reports issued by these companies. So these are companies listed on stock exchanges all around the world that produce financial reports, and there are thousands, millions of people that rely on these financial reports because they have investments in the companies, or they're providing loans, or they're providing supplies and resources, and their financial welfare is dependent on the performance of the company. And so what you've seen historically is that financial information, what we want is information that we can believe and that it has substance to it. Because sometimes, unfortunately, people have created accounting numbers which didn't represent what in fact had happened. So they didn't reflect the underlying economics of the business. And so if we have, historically what we've learned is that where there's no regulation, people will exploit the opportunity to change accounting numbers to suit their own purposes. So for example, if a business is doing badly, then the managers are more likely to want to improve the financial performance, how the company appears to the shareholders, to the owners. So what we have is regulation because of the separation of ownership and management. So where the managers have incentives to improve, make the performance look better than it is. And so we have lots of regulations, including accounting standards, generally accepted accounting principles. And the purpose for that is that for everybody that uses financial reports has the same understanding that these numbers represent assets, represent liabilities, equity, income, expenses. So they have the same understanding with, of course, assuming some understanding of accounting, which you're learning now, so that I can rely on the information to make decisions, and also I can understand that the information that I see in one report is similar to the information in another company's report, because I might be making decisions on which company do I invest my hard-earned money. I work hard to earn money, and then I don't want it wasted or squandered by a company or by the managers. So I want to be able to understand, to help me make these decisions on what's the better course to make for an investment or for another purpose. So there's lots of historically good reasons why there's regulation, and it also helps us understand, have a common understanding what the information means. So we have the regulatory framework in Australia. It looks quite complicated. It is. It's basically there are accounting regulators. In this case, it's the IASB, the International Accounting Standards Board. That's because Australia follows the IFRS, the International Financial Reporting System, with about 130, 140 countries all around the world now have adopted. Have been in the process for the last 10 or so years of adopting the same accounting standards, so that in 130, 140 countries we can understand that the accounting information is pretty much similar, using the same accounting concepts, principles and accounting standards, which helps us even compare financial reports between companies operating in different countries, or just companies from different countries that report using the same accounting standards. In the United States, they use FASB for the Financial Accounting Standards Board. They still have their own accounting standards, which are coming together, but still some way apart. There's also regulation from the law, corporations law in this case, and also the Parliament. It's Federal Parliament of Australia, the Commonwealth Parliament, and there's some other regulators, Financial Reporting Council. There's the audit regulation as well. and then there's GAAP is generally accepted accounting principles. So there's a number there, and for companies that are listed on the stock exchange, the Australian Securities Exchange also has additional regulation as well. So I know it's a bit of a complex sort of picture, but it just reports an overview. So they're the different bodies. There's the Financial Reporting Council. It's just basically an overview body. There's, as I said before, the Acct, the Australian Securities Investment Commission. They regulate all companies. And the Australian Accounting Standards Board, the AASB, they're the Australian regulator, and Australia has adopted the International Financial Reporting Standards, so the International Accounting Standards Board, which has its headquarters, I think, in London, is also involved with accounting standards. Australian accounting standards also have some small adjustments to account, in some cases, for Australian conditions, Australian companies. As I said, the other regulators is the Australian Securities Exchange, which regulates or companies listed on a stock exchange. And if you're working as an accountant, then there's some the accounting bodies. There's the CPA, Certified Practicing Accountants, Australia, and the Chartered Accounting of Australia, New Zealand. They also have some regulation for the individuals that are working as accountants. And there's the international accounting bodies there, the IASB, International Accounting Standards Board, and the International Financial Reporting Standards. Well, it's got 122 countries, so I thought it was a little bit higher anyway. So, okay, so that's the regulation. Any questions on the regulation? So, one of the purposes of regulation is that we can commonly understand what's meant by the accounting information that we read from thousands of companies, from thousands of reporting entities all over the world. We have a few assumptions and concepts that we'll introduce you to here. So there's the monetary principle. So basically accounting records are recorded in money terms. So part of where the accounting items are recognised, we can measure them, so we report them in currencies. So of course in Australia we've got the Australian dollar, and in other countries you'll have reported in other different currencies, US dollars, euros, or renminbi if we're in China. The other item is the accounting entity concept, is that we separately identify transactions relating to each accounting entity or business. So this is my crude picture here, is that we separate an individual's affairs and transactions from the business. So this person runs this business, and they meticulously separate all the transactions that might be my personal transactions from the business transactions. So if I'm running a business, all the transactions will be captured here by the accounting entity, by the business, and I'll separate my personal transactions. And one reason is that I was self-employed for it's probably 5 or 6 years, and of course what you realise quite quickly is that you can't mix up your personal transactions with your business transactions, because you can't measure the performance, you can't measure the statement of financial position if you're mixing up my personal assets with the business assets. And likewise, you won't be able to measure if you're making a profit or loss, because if the money going in and out of my personal bank account, if I mix it up with the money in the business, then again it gets hard to understand how I'm performing. So that's the accounting entity concept, is separation of the accounting records. Going concern principle basically just says, we'll assume that the business continues to operate and that we're not operating, say, under financial difficulty or duress, and we're about to go out of business. The accounting period concept is that, of course, I've talked about measuring financial performance. And financial position. We need to identify a time. So a common time is 1 year, or in Australia it's 6 months. So we have financial reports, half-yearly reports every 6 months, annual reports every 12 months. So we have that accounting period. You could do this every day, but the information each day might not be very useful, and it's generally not useful. So, but over time, the information becomes more useful for understanding the position and the performance of the business. Any questions on those concepts? Okay. The other principle we'll see this in more detail when we look at assets is the cost principle. So when we record our assets, we purchase assets, we record them at the transaction price or the market price or the cost price, generally referred to as the historical cost. And so that's the initial transaction. And when we look at non-current assets in a few weeks' time, what we'll see is the accounting standards will let us revalue our assets, where the value of the assets, of course, often they change. So a simple example would be investments and shares on the stock exchange. Those prices change every hour, every day, every minute, or even. So we can use update the market values or fair values of those assets. But the base starting position is that we'll record our assets at their original cost or historical cost. Any questions on that cost? There's also full disclosure principle. It's a little bit abstract, but basically what we're trying to do in financial reporting, accounting, is provide a disclosure of all the information that you might need, but not to drown you in lots of detail either. So there's a balance between providing too little information where you don't understand exactly about the business financially, and too much information where you might have hundreds of pages to look at in order to understand. So there's a trade-off, a balance between providing the right amount of information for you in order to understand the accounting business. Second principle is very important, the accrual accounting principle, and we'll look at this in a lot of detail in 2 weeks' time when we look at some the adjusting process, and we do adjusting entries for accounts. And that's the idea that there's two types of accounting. There's cash accounting and accrual accounting. And cash accounting is we record the transaction when the cash flows. So there's a cash flow in, we recognise the cash and the event, the transaction. And when the cash flows out, we recognise the event at the time of the cash. Now in accrual accounting, which is what we do, is that we recognise the events and the transactions at the time they occur, because the cash might flow later on. I might do a sale and I might not collect the cash for a month or a week. But I'll recognise the event now in accounting terms. And so there's a timing difference between when the events occur and when the cash flows, and a cash inflow or cash outflow. So this accrual accounting, it's a very important idea, concept, and we'll see this in operation over the next few months. Okay, any questions on our accounting there? We have what's qualitative characteristics. So this is the idea. This is a little bit abstract. Now, accounting information is numbers. It's qualitative or quantitative. There we have numbers. Now, this is the idea that the accounting numbers and those numbers also represent qualities, because the numbers, the way they're produced in accounting terms, is they can be relevant or be accurate representations of the economics, the underlying reality of the business. And so there's relevance, faithful representation. So are two what's called qualities of the accounting numbers. So the numbers, they actually, of course the numbers are quantitative. They represent a number, an amount, but they also have particular qualities about them for our purposes of understanding the accounting information. And the others are that the other qualities that the accounting numbers have is that they're comparable, they're verifiable, timely, and understandable. And so this is the idea that depending on how we produce the number, it could be comparable in the sense that if we can compare that accounting number with another financial report, either another company or an earlier period, and the numbers are more or less equivalent because we've used the same process of recording the accounting numbers. Verifiable might be that we can go in the market and sell and buy items, and we can verify it because there's a market price for the items. So it's verified by a market transaction. So some accounting numbers are verified. The historical cost is the example of that. Timely is that sometimes the numbers are more timely because there's a short amount of time between the transaction and our reporting date, or it might not be timely because there's a long time between the original cost and the value of the asset now. The value of the asset might have changed. So there's a timeliness issue with accounting information. Could be very timely or might not be timely at all. The other quality of accounting information is understandable. So if you go and open up financial reports, some numbers will be easier to understand than other numbers. And so the idea, of course, is that we're trying to produce accounting information that we can all understand and we can also use for decision making. So depending on how the accounting information is produced, it can have a different level of understanding, and you might need to have a different level of accounting knowledge in order to understand it. And so there's the accounting standard setters have, for many years, for decades, have been trying to work out what's the best way to produce accounting information. And of course there are some trade-offs or costs and benefits in having a standards and regulations that tell us how we measure and record accounting information, which leads us on to accounting policy choices. So we'll see in the next few months how the accounting standards and regulations give us a choice on how we account for different items. And we'll see this in particular when we look at assets and even liabilities as well. And so we have choices on how the value that we record and when we record things as well, and what information we need to produce or disclose at the end of the process. So they're what's called accounting policy choices that everybody makes when they come to account for accounting information. And what influences the decisions that we make or the choices we make, and so that's a mixture of the accounting standards, accounting principles, and some of the regulations as well, and also the size of the transaction as well. So we'll look at that in the next few weeks, more specific examples of that, so in making our decisions. The other issue which we'll just introduce now is the idea that when we make decisions on accounting policies and choices is that we might have incentives to, as I said before, managers have incentives to report a better performance, a higher profit, for example. And so the question is the reported profit, is it accurate? Is it a faithful representation? Or was it inflated by the use of, say, accounting decisions and choices? So here's an obvious question. Of course, if we didn't think it was important, we wouldn't be teaching it. So there's lots of accounting information is important because there are, of course, lots of potential users. And as I said before, even if you weren't interested in most of the users, on a personal level, understanding accounting can have lots of benefits for you on a personal level. Okay, that's it for this week. I think I've just finished a couple of minutes early. So next week we'll get into the fine detail of recording transactions and double entry accounting. Okay, I'll stay back for a couple of minutes if anyone's got any questions.
Reserve, yeah.
The English one, it's not included in reserve. They listed separate. So,
which one? So,
this one is
foreign currency.
it's not included in OCI. But
no, it's recorded here in this column there. So it's a special reserve, and it's reported as a translation reserve. That's a very complicated example. Don't worry too much about it. So we'll look at it. We'll look at it in more detail when we look at topic 8.
Thank you.
You're welcome. Hi, sure. Sure.
Exercise 2 shows the cost of sales. The answer is the list I think it should be listed on the expenses, but
Yeah, cost of sales is an expense. Yeah.
so both of these ways are also acceptable. It should be listed in the expenses or should list under the sales.
It's an expense, so this is the first expense. It's just in the size, so it's the highest value, so it's an expense.
That's Oh, okay.
It's an expense.
Okay, the second question is I just imagine the scenario. For example, for one company to book another company the goods, but in next month it cancel this booking. How will it be influenced to the statement?
If you can cancel, then it probably wouldn't recognise until it's legally enforceable. So if you can cancel something, there's no commitment or present obligation. So yeah.
So it will not influence maybe the inventory or the cash.
Yeah. So when you're committed, when there's a transaction, you can't reverse. Then you would usually recognise the transaction. But if you can cancel something, then it's not a present obligation.
It occurred to me to the Boeing company, the 737 MAX airplane, the issues. It just suddenly occurs to me. I want to know where it to influence in the
Sorry about that.
Okay. Thank you, sir.
Okay, you're welcome. Hi.
Excuse me, sir. Do you have some information about applying for the CPA Australia?
I don't have it here, but they've got a big website that you'll be able to. Sometimes they come and do presentations as well, but yeah, I don't have the information here. So, I'm sorry.
I just want to ask for some questions about the application. Of course, my bachelor since has the courses which registered under the CPA Australia, and I don't make sure is it effective. Is it useful if I just make a registration?
Sorry, I don't know. I'm sorry because I'm not involved with the CPA. I'm sorry, I can't really help you there.
Thank you, Professor.
You're welcome. Ciao. Ciao. Sure.
This is half a year and a new rule, but not so quarterly.
Yeah, that should be half yearly.
Half a year.
Half yearly.
Okay.
Quarterly is the US. Yeah.
Okay, thank you.